All right, so we're thinking about paper 5 here. Paper 5, fairly straightforward. You need to get 3 numbers: risk-free rate, market risk premium. We got those. We're going to spend tonight talking about the beta. And we said on beta, you're going to talk about your firm as far as whether it's cyclical or defensive. You're going to talk about the leverage. I'll give you a spreadsheet to do that, but make sure you don't just use the spreadsheet. Well, this spreadsheet will give you some data, but make sure, especially on leverage, operating leverage, you talk subjectively about your firm. Do they have fixed costs? What's their cost structure as far as salaried employees, unionized labor, those kind of things. All right, so make sure you have some discussion as much as you can to try to figure out just the nature of the business. Your discussion might not be consistent with the chart, but remember the chart is my theory. So you might think your firm has a lot of fixed, this is what happens the most. You think your firm has a lot of fixed costs, and then you look at the firm and their margins are actually more stable than the average stuff. And that happens a lot. So you have to kind of figure out what does that mean. You can in your paper say, I would have thought my firm's margins would have been more volatile than typical stock, but they're actually less volatile. But I'm still going to lean toward them having high fixed costs. Whatever, however you want to handle that is fine. It's your forecast, right? There's nothing right or wrong. But there are no right forecasts. There certainly are a lot of wrong forecasts, but no one's got this down perfect. So use your judgment there. So let's talk, and then the financial leverage is most straightforward. And again, where you can really add power to your paper is you got key competitors to run these numbers for the key competitors and just see what is your firm, how much more or less volatile are their margins than competitors, how much more or less debt do they have versus competitors. That works really well. At USA, I had to get a beta for USA. USA doesn't have a beta because it doesn't have a stock price. So I calculated the beta for all of their publicly traded competitors. I figured that the operating leverage would be about the same. So I just took their betas and adjusted it for USA's financial leverage versus theirs. The regulators accepted it every time. They never questioned that. So it worked. It was perfectly good, reasonable way of doing the analysis. So let's get down to the history, the perspective of where have they been. So what we're going to do here on the history is actually calculate the history. I'm going to do Walmart, and we're going to do exactly what Yahoo Finance does so that you have a number to check against. All right. So if you do this correctly, your last number should match Yahoo Finance. And what does Yahoo Finance do? 5 years monthly. Now you're going to see some of my videos do 3 years weekly. Why did I do that? Because that's how Yahoo Finance used to do their betas, and they switched for some reason. So you should use 5 year monthly. You will get a very different number using 3 years versus 5 years, especially with COVID. 3 years versus 5 years, monthly versus weekly, you can get radically different numbers. So our hope is if we do this right, our very last number should be 0.5. All right, so we need it. So you go to your company. So this is Walmart, not Waste Management for a change. You go to historical data. And what you want to do is go back as far in history as you can. So just click on the max. And you want monthly. And hit apply, all right? So get the longest period possible, monthly, and apply. We won't be able to go back this far because for some reason, Yahoo Finance no longer gives us the stock market back that far. It's kind of frustrating. I don't know why they changed. So, and then you just download it into Excel. So again, I don't know what that means. So here they only brought it back to 1985. You don't really need 50 years of data. So 30, 40 years of data is enough. That's 40 years, right? 35 years. All right. I like to get rid of, well, here I'm going to keep the first month, but if your firm starts after 1985, I would get rid of the first month because that might only be 3 days or whatever. So you're probably okay because it probably is, but I use it. I know Walmart goes back beyond 1985, so I'll keep the first month, but I'll definitely get rid of the last month because that's October. It's not the entire month. So get rid of the last month. And in which column do we want? You want the adjusted close. Because you can see that the close is adjusted for stock splits, but the adjusted close is adjusted for stock splits and dividends. So we want that adjustment so that it doesn't get messed up. And that might be one reason why your numbers may slightly differ from what Coffee Finance does, because I don't know if they make that adjustment or not. They use the adjusted reaction close. You know, we could try it both ways, right? I'll just keep them just as an FYI. You know, you might try it just to see as a double check, but whatever number you use at the very end, use the adjusted close. All right, so there's Walmart, the closing, Walmart, adjusted close. All right, so we want a beta. What else do we need to get a beta? Not the risk-free rate. We're going to apply beta to the market risk premium. We can't calculate a beta just on Walmart stock, can we? We need the market. So what could be the market? S&P 500. So here's where it gets really frustrating. So the S&P 500, if you do this when the market's open, you can just click on it. But the market's closed, so they got the futures. So if you're doing this after hours, here's the S&P 500. It's caret GSPC. And that will give you the S&P 500. You could use SPY, but it doesn't go back far enough, so this will work. So let's do historical data. Again, we're going to go back as far as we can, but you're going to see it says 1927. That'd be really nice. It doesn't exist. S&P doesn't exist that long, but we're not going to get that kind of data. And then we want monthly and apply. And what do you notice is missing? There's no download button. So guess what you have to do? You just have to just keep going and going and going. It doesn't take that long. We're already back there. So back to 85. All right. So you just have to highlight it and copy it. Sorry. I'd blame Bill Gates, but I don't think he has anything to do with that. And just paste it as text, and you've got the data. All right. So I don't know why they used to have it where you could bring it right on in. Right here, all we need is the close. I don't know if there's an asterisk on the close, but we're gonna use the close. They should be the same, right? Why are we? Oh, we gotta resort it. All right, so the close and adjusted close are going to be the same, so that's not going to be an issue. Yeah, they say close adjusted for splits, adjusted close, adjust for splits and dividends. They say and our capital gain distributions. I have not found that to be true. So if you took my risk management class, when you bring in their mutual funds, it clearly does not have the capital gain distributions in there. So I think they're lying unless they just made that change. I'll have to look. Maybe it's a change they just made. All right, so we got to resort this, right? So data sort. So we got January through September. And adjusted close is the same. We don't need the volume. All right, questions up to there. We've got the S&P, we've got our stock. All right, so let's get Walmart HPR. What is that? Do I remember that from investments? HPR. Don't remember that. Some of y'all had me before. You should remember it. So holding period return, right? And then SPX, holding period return. How do you get the holding period return? You take the closing divided by the previous close minus 1. Ah, why did it do that? That is, whoa, is that possible? I guess that's possible. 0% return. So ending ending, divided by beginning, minus 1, that's the holding period return. In finance class, you usually do what? You take ending market value minus beginning market value plus accrued income divided by beginning market value. But accrued income is already embedded in the adjusted close. So we don't have to do anything there. So we're just taking ending market value minus beginning divided by beginning. That's the same thing as ending divided by beginning minus 1. So I'm just using the algebra there, but you can do it either way. So there's Walmart. And there's S&P. So if you think about covariance, the whole focus is when the market's above average, 5.4% month is above average, no question, right? Is Walmart above average? When the market's below average, is Walmart below its average? Looks pretty consistent, doesn't it? Now we're expecting a beta of well below 1, but we're going back to 1985. So remember, firms, when they're smaller, they tend to have higher betas than when they're older. Betas tend to come down over time. That's why Bloomberg has their adjusted beta, which I would never use. In fact, it's pretty funny. Dr. Demodarian talks about Bloomberg's adjusted beta, and he asked them, what is that number? And no one knew. They had to go find boxes in the basement and figure out what that number meant. And they finally found someone. But all they do is they have this process that just forces beta to get closer to 1 over time. I don't think that's a logical way to do a beta. So it's a pretty random thing. So how did you do beta in your other classes? You just highlight the 2 things, insert an XY, put a trend line, and the slope of the trend line is your beta. Right? What's the problem with that? We don't know how it's changing over time. We just got this one number for the entire period. So I want to do a rolling beta. So 5-year rolling beta. So how many months in 5 years? About 60, right? So let's go down 60. So there's our first 5-year period right there, right? Right, so 5 years ending January 9th. Make sure you have 5 years, that you don't start right there because you don't have any returns. You want 5 returns. All right, so I'll stop there. Everybody's with me so far? Y'all trying to do this with your own company? That'd be a smart thing to do, right? I mean, you don't need to do it with Walmart. All right, so how do you get beta in Excel? It's the slope function. You have to do your company first and then the market, right? So make sure you do your company first, then the market. Equal slope, or what's the other way you can do it? Equal covariance. Divided by what? Anybody remember? Beta is covariance divided by what? Variance of the market. Did we get close enough? Does that look similar? That's pretty good, right? Which should you learn? I actually think that's the one you should know. And how do you calculate covariance? Anybody remember that formula? So there's 4 formulas you should know off the top of your head: standard deviation, correlation, R squared, and beta. You should know those formulas off the top of your head, and they're almost the same formula over and over again. But beta, correlation, R squared. Correlation is covariance divided by the standard deviation of Walmart times the standard deviation of the market. Beta is covariance divided by the standard deviation of the market squared. So if you know covariance, what is covariance? You're just taking this return minus the average times this return minus the average. You just take the average of those. Remember that covariance? I think you think it feels like you had statistics about 12 years ago or something, but don't forget it. We use it a lot. Powerful stuff. All right, so you can use the slope function or the covariance function, but slope function is a lot faster. So that's just 1 5-year period. So we'll copy that down. So Walmart has a beta of 1.3. That's not what we're expecting. But in 1989, what do you think about Walmart in 89? That was what, 20 years before you were born? So I remember Walmart. I was in college in 85, 86, and I think I've told y'all this story. I remember driving home from UT, and the news reported that Sears was now the largest retailer in the world, and I couldn't believe Sears was bigger than Kmart. That just made no sense to me at all. I mean, Kmart was the big gorilla. There's a Kmart everywhere. There's a Kmart right around the street from me. I rode my bike there all the time, blue light special and all that kind of stuff. I was like, I can't believe Sears passed Kmart. Walmart, no one was talking. I wasn't thinking, wow, I thought Walmart was bigger. But what was Walmart in 89? Walmart was the small city, country town store, slowly taking over the world, slowly coming into big cities like San Antonio and Austin. But no one was thinking about it. At that time, it was a small company. Even though it was a discount store, it was small. And when you're a small company, your beta tends to be higher. Right? And then you come over time. How close was our last number to the one on Yahoo Finance? You feel pretty confident with that number? 0.5, that looks pretty good. So it looks like we did the right thing. So let's look at this graph over time. So what you want to do is put a graph. Before I do that, everybody, any questions on that point? Can y'all replicate what I just did?
That's for our company, right?
Yeah, you'll do it for your company, yeah. And then you see how that very last one should be really, really close to what's in Yahoo Finance. It might be off a little bit. I don't know if we can see if it makes a difference if we do close or adjusted close. So let's try it with close. Oops. Just out of curiosity. Yeah, see, that's exactly the same number. So I want you to use adjusted close, but if you want to double check that you did it right, you can switch between the two.
Can you click on the 0.50 formula?
It's the slope of those 5 years.
Yeah, so is it the slope of the last 60 periods?
Last 60 months.
Okay.
Yeah,
Which
and
one
so
is the last 60%?
well, this is the very last one. So what is Yahoo Finance doing? They're calculating beta over the last 5 years using monthly data. What is this 0.51? The last 5 years using monthly data, right? If you use the actual close, I get exactly their 0.5. I'm never sure if their 0.5 is going through the end of the previous month or they have some October in it, but it looks like, if you use the actual close, you get exactly their 0.5. So that's the key, is you can make sure you got the right numbers, because your last number should be very, very, very close to what Yahoo Finance shows for companies. See, that's exactly what we did, right? We did it over 40 years. Yahoo Finance just does 1 5-year period. Okay, other questions on that? So why do I do it like this when none of you other finance professors do that? I think I told you, I had a guy speak to this class, and that's what he showed. He showed this exact chart. I can't remember if he did 3 years or 5 years, but this exact chart for Merck. And he will make the point betas are way too unstable to be reliable. And he warned me. He says, I'm going to be kind of upsetting you here. I'm going to talk bad about beta. All right, so we'll make a graph out of this. So I've had students put this graph in their chart. Is anything wrong with this graph? We need some dates, right? That'd be kind of nice. So let's put dates in there. Oops, don't do that. There you go, Gates. Thank you. Put some dates in there. What do you not like about these dates? Too much information, right? You really need to know what month this ends at. So I like to use years. What else can we put in here? Yeah, you can definitely put your axis in there, or in this case, it's obvious those are years, so the title can certainly help you. So I'm gonna do Walmart. Rolling beta. 5 years using data. That's sufficient. You don't need the axis titles because it's obvious now that the axis is beta. That's good. A trend line, maybe, I don't know if a trend line, I want, you know, I always want the central tendency here. So what three numbers might be helpful here? Maybe the median, maybe the 90th percentile, maybe the 10th percentile. Wouldn't that be helpful? So we can do equal percentile. We'll just do that entire period, comma. But before we do that, let's lock in. Well, actually, we can just lock in the whole thing. Okay, go with thinking. So equal percentile. Lock that in, comma, the 0.5%. So the median is 0.59. That still seems too low to me. You don't have to use that. The 0.9 is 1.22. That's obviously way too high. The 0.1 is 0.24. Well, when you look at this graph, what else do you notice here? This is Walmart, the small company, Walmart, the huge company. So isn't this period more important? Starting where, about, I don't know, 2004? So maybe this median should maybe be from 2004. Because there's an obvious shift there. So when does 2004 start? We're talking 5 years in 2004, so we'll go 241. So I'm gonna adjust this a little bit. Do it from 241. Boy, those are really, really low numbers. This gets almost back to your point, Sophia, about, you know, almost a negative beta, but way too low for my taste, but I'm gonna put it in there anyway. So you don't have to do your median and 9 and 10 for the entire period. If it's obvious the early period is a lot different than later period, you can certainly shift that around. So I'm going to add those. So here's the median. Oh, I made a mistake here. I didn't, sorry. So on the median, all you need to do is just do it once and then just reference it. You want it to be a straight line, all right? Make sure your median's a straight line, your 90th percentile is a straight line, and the 10%, all right? Y'all see what I did there? Just make it the same number all the way down. Otherwise, it's gonna be really, really strange looking. That's when you know you made a mistake. If your median is not a straight line, 90th should be a straight line all the way across. It means you didn't lock it in or you didn't reference it correctly. All right, so let's add median. Now, if you wanted to on this chart, you could start the median right here, or you could just do your entire chart from 2004. So how do you choose how to do it? Well, what message are you trying to communicate? Right, so it's not like, well, I got to do as much period as possible. Well, the longest period as possible, if that just creates noise, then don't do the entire period. Just do it from 2014 or 2004. You know, so decide what you think is important there. Let's add the 90th, or what is it? 90th. I really don't know if the 90th is the highest or the lowest. I don't really care. So you can decide which direction you're going on that. And then we'll add 10% out. And legend in there. Everybody with me so far? Come on, Bill Gates. This I hate. You never. I want to move the legend, but boy, he makes it so difficult. All right, so pretty it up. Any problems with the legend? Is Series 1 a good title for that?
No.
So let's edit that. Again, Bill Gates. Don't know why he did that. I would get rid of white space. I don't really like white space on here. I want to see as much as I can. So, you know, you might not even start at 0. For Walmart, we need to start at 0 because it gets down there pretty close. But, you know, so pretty it up, make it look professional. Now, I lucked out that my last year is 2021. One thing I wish, and someone, if, you know, Bond in your Excel class, you can do this out. I wish Excel had a way to say, don't start the dates from the left, start them from the right. Because I want the last date to show, not, I don't know if you ever done that thing where you have to keep changing until you get it to be 2021 at the end. It's just really irritating. But I lucked out that 2021 is the end. Try to get it to be 2021 at the end if you can. I also don't like this. It says 1990 twice in 2001, so I'm probably going to change my format here. And let's try, this is watch the 2020, 21 go away. So I'm going to try 22 and see if that will work. Ah, good, that worked. All right, so think about those things. I'd say this, I've had the boss that derails things simply because he finds some small little error. And bosses love that. I had a boss like, he thought he was doing great service if he found my errors. Like, it's not that important. Yeah, but you need to fix that. So if he would see two 1990s, is how can you have two 1990s? It's like, yeah, okay, I'll fix that. And he's like, no, how can you, you know, it's like, I got to explain. So look for those obvious errors so that it, you know, doesn't derail your presentation. Oops. Yeah. Anything else we need to fix here? Looks fairly decent, doesn't it? How much doubt? You might add a text box in here. I don't believe these numbers. I would never use that low of a beta for Walmart, but you know, it certainly has been a very low beta firm. I might go as low as 0.5 for Walmart based on these numbers. My absolute low would be a 0.4, 0.3 if I was really, you know, to me, 0.3 just seems ridiculous. And I'd probably go as high as 0.7 on this firm. But I can't justify it from the chart. Now, I could have easily justified if I put more history in it, because that would have shifted everything up, and then it'd say, oh, look, see, it's really this. So, but the obvious thing there, if I use the entire period, if I use the entire period, does that look right? It's fairly obviously wrong. I mean, you look at the median, the entire last what, 15 years are below the median. So how do you justify the median if they haven't been there in forever? You know, so it's unused. You got the 2008 crisis, their beta shut down again during the COVID. But Walmart is a small company, Walmart is a big company. Kind of makes sense, right? Some of y'all won't have this issue maybe because you don't have that much history, but those are kind of things you're looking for. What would change a beta over time? So that's one of them, the small cap, the large cap. The other is they change their business. They pick up some subsidiary. So is this Walmart? I don't think Walmart did groceries when they first started out. I don't think they started doing groceries until much later in the history. I mean, that's a pretty radical change, right? To do non-groceries to groceries, your whole supply chain management just radically changes. So it's a pretty hefty change. So maybe this is getting in the groceries. The fact that they're larger, the fact that they become the go-to cost leader of the industry, where before they were seen more as a niche. So they went from being a focus to the cost leader of the industry. That could have an impact on it as well. It could also be the fact that we've had some pretty huge crises in the last few years, and Walmart just happened to be at the right place at the right time. So remember, beta can be distorted by unsystematic risk because it doesn't know what's systematic and unsystematic. So pure random chance can make beta be impacted by these things. So what's the right answer? The right answer is whatever the right answer is. You're assessing your view of their risk. This is your opinion of the risk of this company. So it's your opinion. So do you want to use a beta as low as 0.5? So this chart makes more sense to me. It makes, I might actually eliminate these lines here and just put the lines here. I do kind of like the longer history. It kind of makes sense to me to show the change in Walmart over time. Right, y'all now see the difference between that and this. What does this chart tell you about Walmart? If you put this in your paper, what would you actually say? You know, that to me doesn't tell me anything. It seems, and y'all know y'all did these a bunch in your classes, right? But so one thing we know looking at this, that this is two companies. You got early Walmart and late Walmart. Can you see that in this chart? Maybe I color coded them the first 20 years and the last 20 years, then you can maybe tell, right? But you can't tell anything from this chart. So how many of y'all done this chart before, right? For some of your classes, right? Yeah. So yeah, I don't want to diss other approaches, but I don't like this approach at all. This doesn't tell me much. Did they tell you to use different time periods? Say, hey, don't go back so far back in time, or just use all the history you had? Yeah, so I mean, that's, I don't think it's that insightful. So you have to have this chart in your paper, all right? You have to use my approach. If you don't like it, you can discard it when you graduate, but use my approach since the other professors force you to use their approach. All right. And you could certainly put text box in here and say Walmart changing from a focus disruptor, small city, to a cost leader, and then now they're being disrupted by Amazon. All right, can y'all produce this thing? I got it. You might get it to work for your company. Oh, it's hard to do it with a laptop, right, without a mouse. Unless you got it? Okay. So let's write paper. Let's write paper 4 for Walmart, and paper 5, whatever it is. Y'all know what I'm talking about. Just ignore what I say. So we are now going to determine appropriate discount rate for Walmart to value stock. Right, so some quick introduction, that's fine. All right, so some students have asked about this. So do you need to define CAPM? What do y'all think? In real life, what would your first boss think if you had a whole section defining William Sharp and CAPM? Say, okay, don't insult my intelligence. No, your boss knows. And in fact, more than likely your firm has some kind of, well, USA, I can tell you, when I was a stock analyst, there were no rules. No one told us this is how we use CAPM. Every person for themselves, whatever you thought was right. There was zero training going on. It was an amazing, I remember when I first started out, I was so intimidated by the heads of the departments, and they never told me what to do. So I was like, okay, well, I'll try to figure out. I never asked anybody, just kind of like, what I'm going to do here. And it's kind of bothered me that it was like, there's no kind of interaction. There's no overall process. But then you see with like a JP Morgan, there's definite clear company guidelines. This is how we do things, kind of stuff. So it depends on the firm. Every firm's a little bit different. So we don't need to define CAPM, but we need to say using the capital asset pricing model will provide my recommendation or my, I don't know whatever, my inputs for free rate, market risk premium, and Walmart's. They have a little bit of introduction, but other than that, you don't have to define CAPM. All right. This free rate. All right, so I gave you 2, maybe 3 approaches. So you need to have some intro discussing low rates, okay? I don't think you can avoid it. It's just an obvious question. What do we do about a 1.6% 10-year treasury? Right? You might start off with something, I will be using the 10-year treasury as my risk-free rate. However, blah, 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 right? Don't use blah, 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 but something like that. Some kind of discussion. However, rates are unusually low right now. So, you know, some points I would bring up, but you don't have to. I mean, so rates are historically low. With a graph, I think would be really good right there, right? So where the 10-year treasury's been, you can easily do that. Just type, all you have to do is type H15. And that will bring up the Federal Reserve. There's the historical data right there. And you can just dump it right in. You have the data. Back to 1962, and the 10 years somewhere in your, there it is. What do they mean by constant maturity? Remember that from your money making class, constant maturity. So how many 10-year treasuries does the federal government issue today? Probably none. So how can we have a 10-year treasury if they didn't borrow 10 years today? So these are treasuries that have about 10 years to expiration. So there's more than one of them. That's why you can get a different 10-year yield depending on your source. So I remember I told you, when I was in my career, we actually went to the Wall Street Journal, looked at all the 10-year treasuries, found one that was about 10 years out, and we picked one of those. You try to get one of the on-the-run treasuries, but you look at them and you just pick one. All right. So you can just show that history. I can't show it because of these stupid MDs. I don't think it will let me graph it with the MDs in there. But you just have something to just to show, wow, we're at an unusually low point in time. Could you add other stuff in there, a chart on inflation or whatever? You have to kind of decide. So rates are historical low. They've been low for a while. That might be important, right? Especially since the financial crisis. So maybe you do a more recent graph. So take the graph we just showed with long-term history. Now maybe you show just the last 10 years. So that is kind of the argument. I don't want to yell at you. My mom sends me emails with every word in caps. Oh, screaming at me. Sometimes her entire email is all in caps, all in the subject line for like a whole paragraph. Mom. So, all right. So this kind of destroys the normalizing approach, I think. And yet every single semester, even though I say I do not like the normalizing approach, like a fourth of the students do it because they saw it in some previous paper somewhere. So I'm just telling you, I don't like the normalizing approach. I don't think you can argue that you're normalizing something that's been low for 10 years. It's like, when are we going to get back to normal? Japan's been abnormal for 20 years. The US seems to be in the exact same spot as Japan. A lot of retirees, heavy pension debt and Social Security and Medicare debt. So, those are kind of things that tend to push interest rates low and be deflationary. Now, you can then go, therefore, use the actual rate with some quotes, maybe from Gamma Aaron. That might be one approach. Or my approach is COVID still having an impact. That's going to be my approach, that I need to make some adjustment. I don't think we're going to go back to historical 3.5%, 4%, and I'm going to make some adjustment. All right. If you have here, you have the quote, and then you're done. You just go get the 10-year treasury and you're done. So you've got that. All right. Here, what I'm going to do, I'm going to use the forward curve to get us past the COVID noise. So that's my approach. You don't have to use this approach because it's my approach. But now you don't have to actually talk about the normalizing approach. I'm just letting you know, there's no reason to talk about something you're not going to do. It's not like your boss is sitting there, why didn't you use the normalizing approach? There's no one thinking that. That's not like a thing. That's something I talk about. So that's a sweet thing. So unless you have someone that's had my class before, they're not going to know what you mean by this destroys the normalizing approach. It's like, if you want to discuss this more, you certainly could. You could certainly discuss real rates plus expected inflation implies a much higher treasury. However, that's not how you spell implies, is it? However, rates have been low for so long. There's something going on, right? There's something unusual going here. I think it's the heavy levels of debt. I know a lot of people say high debt means high inflation, high interest rates. I'm more on the Lacey-Hunt approach. High debt is deflationary because people have this debt overhang. It just keeps them from spending the way they would normally. And so it tends to be deflationary and actually keeps rates low. But, either way you want to talk about it. If you're in the camp that thinks inflation is going to take off, That may be the one reason to use a normalized approach, because the 10-year treasury is going to shoot up to 3.5% if we start getting 3-4% inflation. So, so there's no right answer. There are certainly a lot of wrong answers, but all right. So that's my approach would be this. I want to at least get beyond the noise of COVID, because I think we're still at an unusually low. And I might point out that we were getting back to 3% pre-COVID. I don't know why Bill Gates doesn't know COVID's a word yet. How long does it take him? Yeah, he doesn't have a capitalized one there, but that's what mine at home does. It's all caps. So pre-COVID, we were getting, that's where this more recent graph might help. You could say, hey, look, going into COVID, we're getting back up in that 2.5, I can't remember what it was, but getting back up into that level. At the end of 2019, well, it was already starting to come back. Remember, at the end of 2019, we're starting to get some recessionary pressures. But at the beginning of the year, we were getting up there, up in the 270s or so. So, yeah. So there must have been something else going on besides COVID to kind of push it down, and people are starting to talk about recession and slow down there. But we were starting to get back, not the normal, but back to a 3% kind of range, which, is to me a more reasonable number. It all comes down to, why would someone buy a 10-year treasury yielding 1.5% if they expect 2% inflation? It makes no sense. Why would anybody reasonably do that? All right. So that's the kind of thing you'd be talking about on the risk-free rate. All right. Y'all see how that works? It's usually about a page, maybe a little bit more, because you're going to have a few graphics in there probably. But whatever supports your case, that's what you want to use. What
was your argument for why that is?
Well, you'd have to read Lacey Hunt. His argument is, when you deleverage, you can't spend, and in fact, he argues that the heavy debt, and there's actually some papers, there's a point where government debt gets so high relative to the economy that the multiplier actually goes negative. And he has data that's pretty scary that shows, used to be the government spent $1 and they get 80 cents of economic growth. Now they spend $1 and they get like 10 cents or whatever. He showed these numbers, and it actually shows it's actually negative. The government spends $1 and the economy actually slows down. It's that sense of the government's doing so much that it's somewhat crowding out the rest of the economy kind of argument. And when people have too much debt, giving them more debt, it comes a point where it just gets a little ridiculous. And we're not slowing down in debt here. Republicans hate debt unless they're in power. The Democrats, it doesn't bother them either way, but it just keeps growing and growing and growing. It's getting to be a pretty scary number. And that's ignoring Medicare and Social Security, which are, tens of trillions of dollars on top of that. That's not even in our numbers. So that's a heavy, heavy debt overbearing debt. And it's not just the US, it's the whole world. So it's a pretty scary thing. You should really read Lacey Hunt if you want to be scared to death. Just do, all you have to do is do Hoisington investment, HOISING investment. Go to their site, and there it is right there. I haven't read his third quarter one yet, but he's a great economist, and he's probably the #1 bond investor in the country, not in the world. Rising debt toll. He has some of the greatest charts. You might find a chart from him that you could put into your paper. So he really, if you want to make the argument the new normal is going to be much lower interest rates, he will definitely give you some charts to show that. So yeah, he has some of the most amazing charts. He talks a lot about velocity of money. So why doesn't government spending increase in the money supply? Why doesn't that increase inflation? Why doesn't it increase economic growth? So y'all remember what is it? MV equals PQ. Y'all remember that? Wait, I shouldn't do economics. Y'all remember this, right? Y'all had economics more than I have. So what is M? Money supply. What is V? The velocity of money. What is P? Inflation, right? What's Q? Y'all had this, right?
Yeah, I did like two.
In money and banking, right? I mean, this is like one of the most important equations out there. I use this equation all the time. So the money supply times the velocity of money is going to do one or two things. It's going to cause inflation or it's going to cause economic growth. So the money supply has been mushroomed, and we didn't get any inflation, and we didn't get, until this year, we didn't get any economic growth. So what's going on? Velocity has been nosediving. So I mean, that's kind of his argument. And he talks a lot about velocity. Velocity had declined nearly 49% to 1.2 over the same period. So if you look at some of his older ones, he has some great charts on velocity. It's pretty amazing. And the other amazing thing is he writes this every quarter, and every one of them has some new radical thing that is really interesting. Here's his marginal revenue product of debt. What is the impact of debt on GDP? Of having more debt? He's just showing that it's just declining. So so now that's just one argument. There's other people out there that are arguing for high inflation and we have high interest rates. That's certainly arguments out there as well. So it'll be interesting. I know he wrote this third quarter, so I don't know how many of the higher inflation numbers he had to address here. So it'll be interesting to see. Working against the economy are the supply side disruptions. So that's obviously part of it. Unfortunately, early stage economic expansions do not fare well when inflation interest rates are not declining at this stage in the business cycle, which is not the normal. So he addresses this. Why would I count off on his paper? Paragraphs are way too long. Yeah, so I would, and his margins are too wide. But, so you can definitely strengthen your paper quite dramatically on the risk-free rate. But basically, this is what you need, some kind of discussion here. You've got to address low rates. You cannot, I'm not saying because of me, I'm saying anywhere you work, you're going to have to address the low rates. It's such a glaring gorilla in the room, or elephant in the room, whatever that saying is. Okay, then market risk premium. So you can say there are several approaches to the, and market risk premium and equity risk premium are the exact same thing. So either one, either title works for me. The third approach is the implied approach, but you don't have to stick just to the implied approach, but I do want you to use the implied approach. If you want to use the implied approach and a couple of others, that's fine, but use the implied approach, mainly because the other approaches require you to get data that you're going to find can be really tough to get. So you might be able to find the historical on Yahoo Finance. You would just say Ibbotson historical, I think he calls it equity risk premium. So you might be able to find something out there. There's University of Texas. I love how on the football scores, they always show Texas SA. Why don't they show UTSA? Why do they call us Texas SA? UTSA is only 4 letters, but anyway, so. Anyway, I just thought, equity risk premium, market risk premium, U Texas. This looks like Damodaran, doesn't it? Is it? I don't know whose this is. So you'll be able to find plenty of stuff. There's people that write about this all the time. So, if you want to go out and do more, you can definitely do more. But you have to use the implied approach. The implied, here you might do a little discussion. Assumes the required return in stocks equals the expected return in stocks given markets. Efficiency. That's a pretty good intro to that section. That's good because we don't have to go find the required return on stocks because we don't know what that is. There's no place to go get that. Other approaches are the historical. They assume that the historical outperformance of stocks versus bonds was what was required. That's a pretty huge leap. There's some people say, well, let's do surveys. Let's go ask people. Well, you go ask people, what are they going to do? They're using the implied approach, and they're just going to give you all the same numbers. So you might as well just do the implied approach yourself. And those are other approaches we talked about. So this one, I think I like the implied approach just because it's pretty logical, pretty rational way of thinking. Expected return on stocks should equal the sum of, and then you're just going to list them and then you can go through each one of them. So income, yield, earnings growth, yield, and inflation, and then the pricing, more analysis. If you want to explain why, I explained why last class. I don't think you should have any PE repricing in there, because if you think market's overpriced, you want to use the higher discount rate. You think markets are cheap, you want to use the lower price. So I don't think you want to. I just don't think it makes sense. But however you want to explain it, so you don't have to agree with my argument on that. But we're going to ignore it. There's no reason to put that in there, right? And so then on the income yield, what are you going to do? So you have the current dividend yield. You use SPY yield. Y'all finance. That's pretty straightforward, right? You can just go look that number up. It's been so ridiculously low. So I'm wondering if it's going to fall below 1% here. I don't know the lowest it's ever been in its entire history. I think we're getting close. Boy, maybe back in 2000 during the .com, we got down. I can't remember. I don't know what its lowest number is. Maybe Google knows. Lowest dividend yield in history in India is the lowest since 2001. That's not all that impressive. During the 90 years, the dividend yield never fell below 3%. That's up through 1960. So yeah, I mean, what does that mean when the dividend yield is so low? Well, for most people, that means stocks are grossly overpriced and too expensive. Back in the 40s, 50s, and 60s, dividend yields should always be higher than treasury yield because stocks are more risky than bonds. That's gone away. And now we actually have a dividend yield back below the 10-year treasury, even with the 10-year treasury being so low. Is there a way to justify this? Well, you might want to do the buyback yield. I think I said use 1.5% from Gibbetson. So you can just quickly put that in a sentence without a lot of discussion. If you do want to get into it, you can definitely get into it. If you want to read through the highlights of that article and put some quotes in, that's perfectly fine. You might put a chart in from there that shows that the buyback yield has passed the dividend yield the last several years. That might be a powerful thing to do for your paper as well. All right, y'all remember the buyback yield. The problem I have with the buyback yield is that it's a little bit concentrated in certain industries. So it's hard to say, to say you're going to apply this to all stocks equally. Notice what's not in here. What happens to your grade if you use Walmart's dividend yield? Just lost a bunch at once. All right, because this is not the expected return on Walmart. This is the expected return on the stock market. All right, so definitely don't use that. That would be wrong. Don't talk about your company buying back its stock. That has nothing to do with this number. All right, this is all market data. Same thing with the risk-free rate. You're not talking about, and I don't know how you talk risk-free rate related to Walmart, but we're talking entirely about the stock market here. And then earnings growth, I'm going to say this is a function of economic growth. You can certainly show the chart that I gave you all on that shows corporate earnings growth versus GDP, or remember that chart? That can certainly be powerful. And then you say economic growth equals productivity growth plus labor growth plus inflation. We've got a chart on that as well, right? That bar chart that I showed you last time, you could certainly show. You could have a discussion on productivity, labor growth, whatever you think is going on there. We know it's been fairly weak on both of them here recently, last 20 years. You can certainly discuss what's going on there. If you can find some perspective numbers on that, you could certainly do that. That would be fine. But it ultimately comes down to your opinion. What do you think is going on? This first chart shows you corporate earnings growth slowly and economy, but it is close. So I'm just going to make the leap and say they're the same. The article I showed you from Barclays actually projected corporate earnings to grow faster than the economy. So that was kind of interesting. All right. And then inflation, what could you do there? You got the Fed target or the forward rate. I have YouTube that show you the forward rate. Why would you do the forward rate? Is it because it's better? No, because you put the forward rate into your paper, it just looks more impressive, right? I'm trying to get people to hire you, so do the most sophisticated thing possible, or maybe do both. Say, hey, the Fed is targeting at 2%. We don't know if that's a max, a target, or an average. They're kind of, if it's an average, then they're going to let inflation be above 2% for some time to get us back to that average, whatever. But the forward rate, you can calculate that off almost the exact same way you did if you did the forward rate up here. It's just you do the same thing for tips and then just subtract them and you've got that forward rate on inflation. So, that's pretty powerful. And when I was watching Bloomberg Market Concepts, so I don't know if you remember this, but they actually showed you in Bloomberg where you can find the forward inflation rate. I don't know if you saw that. I forget what function that was, but so if you don't want to calculate it, just go to Bloomberg and you got a screen that actually shows you the actual number at all different terms. Right? So you take the sum of those, sum equals expected return on stocks, expected return on stocks minus your risk-free rate equals the market risk premium, and so you're done with that piece. That makes sense? Now here's the part where the previous papers can help you a lot, unless you do copy and paste, and then it's going to crush you because you're going to get a lot of plagiarism. So you got to put it into your own words, but you're perfectly fine reading previous papers. You're going to find it's going to get a little boring because they're all very, very similar. Because everybody's doing the exact same thing. But that's fine because there's not a whole lot you can really do creatively here. with the implied approach. There's just not many places you can go here. Okay, questions up to there. You got 2 of your numbers. And if your beta is 1, you don't hardly even care about this part here because you're gonna get these. Your discount rate is going to be the expected return on stocks. So the further your beta is from 1, the more expensive, more important is this risk-free rate discussion is. Now, it'd be a really sophisticated thing to put into your paper or bring into an interview. Say, I put all this time into the risk-free rate discussion, but I'm doing McDonald's and I think their beta is pretty close to 1. So, it's all just academic because it doesn't really, you could certainly bring that in the discussion. All right. So far, I haven't done any scenarios, and I recommend you not do scenarios in this case. And the reason I recommend you don't is that whatever you pick here, you're going to use for every stock equally. And usually what we're trying to do in finance is not figure out the stock market's cheap or rich. We're trying to figure out if our stock is rich or cheap. And so these assumptions won't change that because you're using the same numbers for everybody. All right. So that's why I'm not, if you try to figure out the stock market's rich or cheap, then yeah, this becomes far more critical. And then you don't need the risk-free rate at all because the beta then is 1. So, to get too fancy there, I don't need 7 scenarios there. All right, and then the beta, pretty straightforward. Very straightforward. You start revenue sensitivity. This is a discussion of cyclical or defensive. I have had some students go back and look at previous recessions and see how did the stock do in those recessions. That can be an interesting discussion. But what I really focus on is the customer behavior. How are they going to react to recession relative to the products this company sells? All right. So it really is a subjective type of discussion. Then you have leverage. So you have operating leverage. You need to have a discussion. This is where students lose a lot of points where they just go get the chart and that's all they do is use the charts. Have a discussion. Does your firm have fixed costs? What kind of fixed costs do they have? Well, I was listening to a podcast on Uber, and I had no idea on Uber last year. It was pretty disastrous, you would have thought, for Uber last year, and yet they make money during COVID. How do you make money in COVID when your ridership drops 70–80%? That their costs, most of their costs are the drivers. You don't pay your drivers anything. That's the nice thing about them not being employees. Now they're struggling on the way back because they lost all those drivers. So now they're trying to beg. So now they're losing money because they're having to bribe their drivers to come back. But I mean, it's interesting that they have that kind of dynamic where you really very, very variable cost. And then you have the chart, the volatility of margins. What if that's inconsistent with your discussion? You'll have to somehow reconcile that. And then I would say compare to key peers. I would think I've had very, very, very few students do that, but I think some bar chart or something like that would be, I think, really. And how long would it take you to do it? I mean, you're talking a few minutes, I think. You just pull their ticker, get the numbers, write them down, and then do the charts. I think that'd be interesting. I would find that really interesting. I don't know why students don't do it because it's something to be really interesting. Doesn't take much time. Then you have financial leverage. This one's the easier one. You have the chart and compare peers, maybe. Pretty straightforward. Most people get pretty close to full credit on that one. Now, I know there's a formula for how do you adjust beta for leverage. You don't need to use that formula. I mean, if you want to, you can, but it's not required. All right. And then you have the history. And then what do you have? Summary table. We above 4, final recommendation. Why am I doing that? Because a lot of students lose a lot of points here. It's kind of like the Porter's discussion, right? Students go through the whole Porter's and then they come to their conclusion. They never mention the Porter's again, which is the whole reason they're doing the Porter's, is to get to the conclusion. So why did you do these 4 steps? So you can get your final beta. A lot of students do the 4 steps and then they just look at the history chart and pick the median and they're done. It's like, okay, well, is that consistent with the other 3 steps or not? So a summary table will certainly help you with that. So the table would be step 1, step 2, step 3, revenue sensitivity. The next would say what your conclusion was in real short words, and then what that implies for beta, maybe your range. So 3 columns. And then you need your betas. Base, best, that's the lowest, and worst. And be careful here. That's part of my fear with Walmart. Remember, if your betas get too low, you're going to get a discount rate that's really low, and that's going to give you some crazy numbers when you do the valuations. So you have to be a little bit careful here. So that's the highest. And that's the last part of your paper there. So you summarize what you came up with. So there's paper 5. Paper 5 you can probably get done in a lot less time than paper 1 and 2 for sure. And this is pretty basic finance, right? So if you weren't comfortable with doing this, you've got to be able to know how to do this when you graduate, because this is pretty basic what finance people do, right? You've had this in how many classes now? Probably almost every single one of your finance classes covered this. So now you get to do it, from scratch on your own. One thing that bugs me a lot about finance is they give us the risk-free rate, they give us the market risk premium, they give us the beta, and they say, hey, calculate cost of capital. They give us all the hard stuff and ask us to do the easy stuff. And then you graduate and guess what happens? Your boss doesn't give you any of that stuff. And if they do, why are they paying you $400,000 a year? So, okay, here's your beta, here's market risk premium, here's your growth rate, here's your dividend. I need you to calculate the value of this stock. No, they don't. You could pay me $100 to do that. I can plug that in and get you the numbers. So this is what you need to do as a finance major, is come up with these assumptions and justify them. That's the key to you being a professional. All right, we got it. Stop there. I'll give you 2 minutes so you can go work on your other papers. Get paper 2 and 3 in this weekend. If you can't get 4 done, you can see you got some catch-up time here. All right, so hopefully they can hear me online. Recording. All right, so you've got the industry analysis, your company analysis, and the financial analysis. Some of you are struggling on the forecast. I'd say get papers 2 and 3 done. If you get me late, it does get much easier as we go past. So if you're going to be late on paper 4. Some of you, I'm not trying to stress you guys out, but forecasting is what you do, is finance major. And some students, it's probably the majority of students, it's like, I have no clue how to do a forecast, and they're about to graduate as a finance major. So try to figure it out. If you don't know how to figure it out, set up time with me. I'll sit down and show you how I would do it. I do every company very differently. You can see how we're doing Costco. We're going through and saying, hey, we should combine these 2 lines. They're not that material. We better break this line out. So for Costco, we're definitely breaking out unearned revenue because it's a big number. For some companies, I would just pump it in and put it in with other. So students ask me, what exactly do I do? And what exactly you do is whatever that company requires. There really are, and I don't think, almost doesn't make sense to teach a forecasting class, because every company is its own thing. So what do? You take all your accounting, all your finance, you look at a company, you look at the history, and you're going to try to figure out how to push that forward. It really is, that's what it's all about. But the most important number is revenues. So you can't just take, well, the revenues have been growing by 5%, so I'll grow them 5%. That's just not going to be enough for a revenue forecast. You got to put more thought into it than that. And some of this, you really don't have enough data to be able to do a great forecast. So some of this is creative writing. You're going to take something you're not all that sure about, and boy, you're going to make it sound like it's the greatest forecast in the world when you write it into your paper, and that's fine at this stage to try to put something down, But yeah, forecasting is tough. Paper 5 was pretty straightforward, right? You just essentially writing
what you learned in all your classes. You've had that every class in finance. So it's putting down what you believe. Some students struggle because they've never been asked to put down what they believe. They're supposed to put down what the professor believes, but you can't do that anymore. Those years are over. You got to figure out what you think about risk-free rates and market risk premiums and betas. You got to put your own stuff down. So the same thing is going to apply paper, whatever, 6. You already know all this stuff. You've had it 2 or 3 classes already. So now you're going to do it again, but you can do it specifically for your company. And so paper 6 is valuation. Paper 7 is valuation. So we have 2 valuation papers. The rubric for paper 5 says to do a summary of your valuations, but I'm going to allow you to leave that out mainly because it's better to put that at the end of paper 7, because you're going to, you don't want to summarize your valuations in 6 and then summarize your valuations in 7 again. What some students do is they summarize their valuations in 6 and then they cut and paste it at the end of 7 and just edit it a little bit. But let's talk a little bit about where we're going with this. Let me give you the bigger picture. So you remember all this, right? Y'all done this, oh man, probably at least 3 different classes. So we're talking about valuation. Valuation is real simple. It's a discount rate. You've already got that, all right? That's paper, whatever it was. And growth. So paper 6 is what? It's like one number. It's a growth rate. It's more than that, but that's what paper 6 is all about. So what models are we going to use? So these are the models that I recommend you use, and let's see how many of these you know. So the dividend discount model. Y'all remember that formula, right? Anybody can say it off the top of your head?
No. I think my head is
You got it. R, so what is R? I don't use R, not WAC, but you're close, a part of WAC. Required return on equity, cost of equity capital minus G, right? It's the perpetual growth model. The Gordon growth model, again, I always, like, why did Gordon get a model named after him when it's just perpetual growth model, right? This assumes dividend 0. If you're using dividend 1, what do? You leave out the 1 plus growth, but what dividend will you have? You're gonna have dividend 0, right? So dividend 0, where do you get dividend 0? Let's go look it up because we're gonna need it. So if you go on the Yahoo Finance, oh, that's a great picture. I remember CNN several years ago, they had a picture of Barbara Bush, and they could have picked any picture of Barbara Bush for this really nice story about her working with children, whatever. They picked the ugliest, horrible, they caught her and turned it, and I was like, why would you do it? All right, so let's do Walmart. So you're looking for Walmart. Let's see if I can get Walmart, not waste management. There's Walmart. If you click on historical data, and just instead of prices, just do dividends. Apply. Dividend 0 is the last year. For Walmart, they pay dividends quarterly, so you just add up those last 4 quarters. All right, it's real simple. Why can't we use the dividend here? Well, again, Yahoo Finance has changed this, but they call it a forward dividend. That is not a forward dividend. There's no such thing as a forward dividend. So, when I say forward, it means it's somebody's forecast, but this isn't somebody's forecast. What did they do? Anybody guess how they got 220? This is 219. How did it get from 219 to 220? They just took this last dividend and did what? Multiply by 4. That's all that 4 dividend is. Whatever the last dividend was times 4, that's the dividend. I don't know what they're going to do with Costco with the wild fluctuations. All right, so you need dividend 0, which is just whatever the last 4 dividends are. We're going to talk about your firms that don't pay dividends, how we're going to get around that. Okay, I have a solution for that. All right, so that's pretty straightforward. So that's an easy number to get. What are we assuming? What are we assuming dividend zero equals? We're assuming dividend zero is a good proxy for free cash flow share for equity. Is that a right answer? Darren says yes, about 5% of the time. So 95%, which means most of your stocks that would not be true. So we're making this huge assumption that dividends approximate free cash flow per share. All right, so there's one model. What about the H model? Anybody remember that one? It's almost the same formula. You have to remind me. Well, so we start with this formula, right? And what we're going to do with the H model, we're going to add a super growth period in there. All right, so how do we get this super growth period in? So again, we use dividend zero. Here what we're going to do is do growth short term minus growth long term. We need one more number. The H. What is the H? Let's talk about the H. F. So it's like time. Yeah, it's a time. It's a half-life of the time. And this G down here is G long term. Another term for G long term. Anybody know that? Terminal growth. So terminal growth, that's a term. If you're interviewing, make sure you know the term terminal growth. That's pretty critical. What is that? That's the ultimate growth rate they're going to get to once they get through whatever this weird period of time is. Some companies may already be there. They may be. This is their normal growth forever. They're not growing. They're not expanding. They're not doing anything unusual. All right. So all we're going to do here is we're going to add this additional piece. So students going to say, well, where do I get growth short term and what I get the H? We're going to talk about that tonight. All right. The H especially is really, really difficult. I've even had students email me, where do I look up the H? It's like the same place you look up GDP in 2027. Your guess is as good as mine. So these are assumptions, but we do have some basis for coming up with this number at least that we can talk about. All right. I love the H model. When I was in school, we had to do the multi-growth models, which are just ridiculous formulas. They're just massive. And I even had one exam where we had to write the entire thing out by hand. It was crazy. Why would you have to memorize all that, especially when you have Excel? H model allows you to do that in just a real quick way. So you don't have to do these massive formulas. So you essentially just add this little piece in there. I've been using the H model. I was on the CFA exam. It was like in a footnote on page 16 of an article they never asked the question about, but I saw it and thought, man, I'll win this. This is great. All right, now we're going to get this next one. If you use this next one, you're going to have to explain it some because it doesn't exist anywhere out there. And I call it the capitalized earnings model. This is a sweet model, and that doesn't mean it's really good. That means it's my model that I came up with. All right, so I know the word sweet means other things. All right, so you must explain this one, the theory behind this one, because if you just tell someone, hey, the capitalized earnings model was this, no one's going to know what that means. Dr. Darren has talked about this model, but he doesn't call it this. And he's talked about it, about what a horrible model is, and you should never use it. I disagree with him on that, but he's a lot smarter than I am, but you still can use this model. So essentially what this model does is it says, what would the current state of this firm be worth? All right, no expansion. We just take the current state of this firm exactly like it is. Walmart doesn't add any more stores, doesn't go overseas. doesn't do any expansion whatsoever, how much would we value that company? And so essentially what I'm saying is they pay out 100%. So they pay out all their earnings, which means what? Earnings per share equals dividends. Right? Because if they pay out all their earnings, then their earnings and their dividends are the same number. Now here's the controversial part of this. So what is growth? Yeah, I say inflation. What does theory say? Theory says 0. Now remember that model, we'll look at it, but sustainable growth equals ROE times retention. If we pay out 100% of our earnings, what is our retention? 0, so what is our growth? It would be 0, all right? So that's the theory. But I say inflation. Now, I heard Damodaran answer this question when he was talking about this and when he's bad-mouthing my model. So he said something that is not correct. It's really rare for him. But if you have revenue of 1,000 and expenses of 800, net income of 200, and everything grows 2%, he argued that if your revenues grow 2% and your expenses grow 2%, then your net income doesn't change. Is that correct? My income going to be 200? What is it going to do? It's going to grow 2%. All right. So he got that question. I don't think he really stopped to think about it. And he just answered, well, no, you don't get any growth because inflation. So he addressed that issue of inflation. Inflation hits your revenues and expenses equally. So you end up with the same net income. But that's not true. So the other question is, well, what about maintenance? Well, my argument here is you have depreciation, which is what? A cash flow not distributed. Isn't that true? You distribute 100% of your income. Does that mean you have no cash? Well, no, you have your dividend. I mean, you have your depreciation. That's an expense that you take out of your earnings, but it's not a cash flow. So essentially I'm saying maybe depreciation can give you enough to take care of those maintenance kind of things. All right. Over time, who knows, but it's a good approximation of what maybe you could achieve. So essentially what I'm saying is if a firm pays out all of its earnings so it can expand, can add stores, it should just be able to grow with inflation. And in that case, it should be the dividend discount model. But in this case, our dividends are no longer dividends, they're earnings per share, and our growth is no longer growth. It's inflation. It's the same as the dividend discount model. I just changed my dividends and changed my growth. It's the same model. This should give you the lowest value. It should, but very frequently it doesn't. Why doesn't it? And there's a good reason. That's one reason I like this model. Why might this model grossly understate the value of the firm? If your dividends are $2, but your free cash flow is $4, that model is going to grossly value your firm. And so if you get a $50 value here and you get an $80 value here, it probably means the dividends have nothing to do with the free cash flow. That dividend number can just be a random number. It has nothing to do with valuation. And so this might be eye-opening to you. The other thing I like about this, when we get in the investment society sectors, this is one thing some of the models might add at the very end. I really like to calculate this number and compare it to the actual value of the stock. And what I'm looking for is what are those companies where the overwhelming majority of their value is all the new stuff they're doing. So if this is what the firm's worth as is, and that's say $20 billion and the firm's worth $180 billion, I got $160 billion that management's gonna have to do new to justify this stock price. That's a pretty tall order. If I do Campbell Soup and I get 40 billion and Campbell Soup is trading for 38 billion, and it's like, yeah, I mean, there's not much they can do here. So it's pretty close to its valuation. All right, so I like that. It's common. I don't know if y'all heard this, Tobin's cube. Did y'all have that in the class before? Heard it? Fernand, you've heard of it? So what? Oh, I don't know about that. I've never heard that before. Let's explain it. So what Tobin's cube is trying to do here is essentially what I'm trying to do is they're trying to figure out how much would it cost to rebuild this company from scratch? If I were going to create a Facebook, how much would it cost me to create it? If it cost me 200 billion and the firm's trading for 600 billion, then wow, I get kind of a problem. So it equals the market value of the company divided by its replacement cost. Expresses the relationship. This is pretty good. Investopedia doesn't always do a good job, but they're doing a pretty good one here. It is a means of estimating whether a given business or market is overvalued, undervalued. A guy named Tobin. I had a lady work for me. Her last name was Tobin, so I used to tease her. I don't think she was related to him though. And he didn't even invent it. Well, I didn't know that. It should be the Caldor ratio, I guess. With a firm or a market is relatively over or undervalued, it relies on the concept of market value and replacement value. So it's the market value of the firm over the asset value of the firm. So that sounds really, really good. I mean, great ratio. The problem is figuring out the replacement value of a firm is not an easy thing to do, right? It's pretty easy with your house, right? How much would it cost me to rebuild my house? That's not too difficult. And you could do a Tobin's cube with that. But a business like Facebook or Alphabet or whoever, that's a pretty tall order. So I think this tends to be more of an old economy where you have a bunch of manufacturing plants and trucks and those kind of things, and you could actually do that. So this is kind of my poor man's Tobin's cube. So maybe we need a sweet cube. This is the sweet cube. But it's a different than Tobin's cube. To me, this is not what the firm should be valued. This is what the value of the firm's existing operations is. So I like it from that standpoint. So you do need to explain why you're using this theory if you use it. The nice thing about this is, as long as your firm has positive earnings, the ratio works pretty well. Whatever you used in paper 5 is what you should use. So go back to your paper 5 and see what you assume there. Yeah. Be consistent between your papers. What I don't want you to do is to use scenarios of inflation. Just pick one inflation number and go with it. You can use your different betas here, but just use one inflation number. All right, so those are 3 models. There's another model we're going to use, but we're going to do it in paper 7. And that is, the investment bank approach. I don't really like this approach. Damodaran doesn't care much for it either, so I'm kind of in good company there. But it's so heavily used, and if you interview with the investment bank, you better know this approach. But we're going to leave this to paper 7. So this is the valuation you're gonna have at the very end to bring everything together. So I mean, it's interesting. Dr. Damodaran in his class that he talks about relative value. He said, I used to not teach relative value because it's not really theoretically correct. You got like massive amounts of assumptions all in one number. And somehow finance says we can't get those massive assumptions, but boy, we can come up with one number that represents all of that. And we feel really confident about that. And he's like, that doesn't make sense. How would you do that? But it's just this way that feeling. And then he noticed, and his student says, yeah, we're going to use these models. We're definitely going to use discounted cash flow models. And then he'd ask his students 5 years later, 10 years later, Says no one's using discounted cash flow models. They're all using these relative value models. And a student says, no, this is what we're doing. He says, no, that's not a discounted cash flow model. That's a relative value model. So what were the students doing? Where you forecast free cash flow until your firm reaches what? Terminal growth. Could be 2 years, 10 years, 0 years. So you forecast your free cash flow until your firm reaches terminal growth. You then apply the relative to earnings terminal growth. You then take the present value of the free cash flow plus present value of the terminal growth stock value. That equals the value of the firm. Why does Damodaran says this is not discounted cash flow? Everybody says, well, it is. We're taking present values. He said, but 95% of your present value is something that relies on a relative value, a relative price relative. So you're really using price relatives, but you're making it, you feel good about it by doing some discounting cash flows. It says that. So, okay, they're gonna pay dividends for 4 years. And then, so that's $1, $1.20, $1.30. And then after 4 years, the stock's been worth $182. So I'll take a present value of those $1 and $2 and then the present value of $100 and something, and that's the value of the stock. What did you just do? You just did a price relative. So, but this is the most common approach. So you're going to see on this one, this is why your forecast is so important, is you're going to use your forecast from paper 5 and your price relative that you came up from paper 7, you're going to apply it all together. So we're going to have to, we'll address this one when we get there, all right? But this one's coming, and just let you know that this is, you know, a very popular approach. And I'll show you how I did it in Walmart. On the Walmart forecast, I only went out 5 years. If your firm, if the terminal growth much more than that, you need to go out more years, but that's not that difficult to do. You just keep copying the columns on the forecast until you get to the very, very end. You don't have to do that for paper 4, but we will need to do that for paper 7. But the key is, I've got to tell you how to come up with this relative. I'm going to definitely steal that from Dr. Damodaran. I like his approach on that, so how to come up with a reasonable relative. All right. Now, another one that you can do, and I'll show you this one probably on Tuesday, and that is just what I call proprietary valuation model. Excel. And I'll show you my approach on this. This is essentially an H model with adjustments. And I'll show it to you, but I like this approach. I think it works pretty well. I've used it for, it works well for really high growth companies that aren't paying dividends. Problem is, it's a little tedious because you have to put your assumptions in, get your numbers. So if you're going to run scenarios, you're going to have to do it one at a time. You can't just, you know, plug it in Excel and get it. You probably have to run it each time. But it, you know, it's not that time consuming, and it works pretty well. But it's essentially set up with the H model. Essentially what it assumes is their earnings grow at a rapid growth rate that declines over time. But as soon as they get the terminal growth, I'll put this in the assumptions here. The year they reach terminal growth, they start paying the normal dividend. And then you take the present value of those dividends. Right? So the key is your earnings growing fast, which is going to increase your dividends once they start paying dividends. But if they're growing, you know, their terminal growth is 5%, but they're growing 9%, 8%, whatever, they don't want to pay dividends because they're growing so fast. So let's let them retain all their earnings until they hit that terminal growth, and then we'll start paying dividends and we'll take the present value of it. All right, so it's a real simple model. It's not quite the H model because I do it as almost a straight line drop in growth, whereas the H model is more curved kind of drop in growth, but it still gives you, I think, a pretty decent answer. All right. So those are the models that we have. You have to have at least 3 models. Okay, so you got to pick 3. There are other models out there that, if you want to do them, so there are free cash flow models. This is the one, boy, I probably should turn off the video. All the professors got together and they decided we should require Ron to do this model in his security analysis class. It's like, okay, thanks guys. So I have to at least, we have to at least go through it and do it. So I'm going to do it here, but how do you do it here? So let me tell you why I don't want to do this. Class is already hard enough. You're doing stuff you've already done before. You've already got a lot of stuff to do, but the free cash flow model says what? You take the present value for the free cash flow of the firm, you subtract the value of debt, that equals the value of the firm. What is your discount rate here? WACC. Where have you calculated WACC? On paper 5, what did you do? On paper 5, you calculated what? Cost of equity. All right. I don't want you to calculate WACC because it's a whole extra bunch of steps of stuff that you've done it already. You did it kind of back in class. You already know how to do it. It's very tedious. It's a lot of work. And I don't want to do it. All right. So that's just my opinion, is I don't want you having to go through that extra work. It's just a lot. So I prefer not to. Now, you could instead do the present value of free cash flow to equity. Then your discount rate is what? So what's the difference between free cash flow to the firm and free cash flow to equity? It's really simple. You just subtract one number. What is that? Yeah, just interest expense. You just take out the interest expense. Make sure you do it net of taxes. But you just take out the interest expense and you got it. So, it's not that big of a stretch for me to say we're using these models. They really want me to push this WACC, and I think it's probably because they want to make sure you know how to do that, but I'm assuming you know how to do it because you've had it in at least one class. So y'all all calculated WACC sometime in your career. You know how to do it. Cost of debt's the hardest one, and I think it's really messy. Bloomberg does have a cost of debt that you can pull. I don't know how accurate that is. You're supposed to use the market value of debt, and that's really hard to get. And you can go to Bloomberg and try to get all that stuff, but if they have capital leases and all this other stuff, boy, it gets really, really messy. So, so it probably adds 3 to 4 hours to your paper. All right. So if you want to do that, that's fine. But here's my solution for you. So Henry, those of you who don't have dividends, this is what you can do in lieu of dividends, is to come up with the free cash flow to equity and use that as your dividends. So free cash flow of equity per share can be a substitute for dividends. All right, so we have to figure out how to calculate that. So I'll show you that. We'll use a formula. I'll show you my formula, and you can use my formula or what you learn in Data Package class. You should get very similar answers. All right, so that gives you the ability to essentially use all of these other models, but use it for a firm not paying dividends. So it kind of solves a real quick problem. So I actually don't see this one. College professors talk like everybody's doing this, because theoretically it's the ultimate model. I don't see it out there in practice that much. Why? Because finance people are lazy. We don't have to do all of that. The other reason I don't like this model is the students have tried it, have gotten really wacky answers. Tends to give answers that are just like, so they have these other answers that are all kind of close together, and then this free cash flow one, they get something that's like 3 times the value. It's like, what did I do wrong? You know, you did it just right. You just get really wacky answers when you do it like that. So that's part of it is really is kind of strange answers.
We did that for sector was, and you sector back in 2019 with the DCF. And comparing it with the other models, it's,
Yeah,
it was really wacky.
it's part of it, I think, is, and you get it if you read my free cash flow blog. I mean, part of this is really defining what free cash flows are. That's the nice thing about a dividend discount model. You just use dividends and hope it's somewhere close. Now, obviously, there's other models. So the contingent claim model, I doubt any of y'all are going to do that, and I can't even spell it. Contingent claim model. Dan Daring covers this in his class. I doubt any undergraduate. Have y'all had this at all, undergraduate? It's not a real undergraduate one. Dan Daring does it in his graduate school. It's a pretty intense class. I mean, it's pretty interesting watching Dan Daring's class and Dr. Lowe's class. It's obviously Dan Daring is not teaching graduate students. He's teaching graduate students who want to become CFOs. They're clearly finance majors, versus Dr. Lowe's teaching all kinds. So Dr. Lowe's class is no different than my 3013 class. So it looks just like my undergraduate class. Dan Daring, he does a contingent claim model. The nice thing about his class, though, is he sends them an Excel model and they just plug in their assumptions. So he's done a lot of the work for them. So, but contingent claim, while you may not use it, you should think about it because it is an important concept. So what does contingent claim model say? Well, there are some firms that have opportunities with huge upside. But they have the option to stop if not working. So that's pretty important. So you take a pharmaceutical, anytime they could create the next great drug that's just going to become a $10 billion drug, or they might spend, you know, a few $100 million and not come up. So it's kind of like an option premium. They spend the money, or an energy company, they spend money to go search for oil. They don't find any. They wasted some money like an option premium, but they find something that's massive on the upside. Disney does the next Toy Story. Costs them 50 million, 100 million to produce. It's an average, maybe they only make 50, 100 million, or it's the next Toy Story and they make a billion, you know, it's that kind of thing. Does Walmart have anything like that? What could Walmart do? They do a little bit of it, and if it works, boy, it could be earth shattering. I can't think of anything for Walmart.
Sure.
Uh-huh.
It would be like, you know how you can like get groceries to your home,
Do what?
groceries, so you can buy it online and you send it to your house.
Yeah, delivering groceries, but it's not gonna radically change. So before grocery delivery, you were buying $100 of groceries a week. Now you're gonna do $700 of groceries a week. Or Walmart's gonna be the only grocery store left standing because they do that. So it's gonna have, so to me, yeah, that might add 5%, 10%. We're talking, so to me, it's Uber doing food delivery in Europe and, you know, getting it to work.
HEBs that now have like their own brand. So I don't know if Walmart like owns like Great Value or like the cheapest option.
Yeah, and the company-owned brands, those are all nice, but on contingent claim, we're talking something really radical. It's a new movie that is $1 billion movie. So Star Wars, a new Star Wars type of thing. Everybody's going and watching it. Maybe the Marvel movie. I have not seen one Marvel movie yet. I don't know how good they are. Huh? Yeah, McDonald's doing breakfast probably could have been that back then. Yeah, but it's something radical. You think about energy companies, pharmaceuticals, the media companies that are doing, you know, some breakthrough thing that just takes off. So a lot of firms don't have anything like this at all. So, you know, most of, I can't. If you have a product that could be radically used for something new and that takes off, then yeah, that could be. It's got to be pretty substantial. It's hard to think of something like this, say for Apple, mainly because they're already a $2 trillion company. Well, Facebook and Apple with the credit card or cryptocurrency, those kind of things, they could be. Yeah, so the idea is you don't have to say, well, this thing has a high probability of success. All you have to say is, if this is successful, it could be massive. So to me, autonomous vehicles and Uber figured that out and being the first to figure it out. That would be pretty massive. Uber's trying to figure out the rideshare multiple party thing. So I need a ride to the airport. Oh, there's 2 other people in San Antonio that need it. I don't know who they are, but if the 3 of us get together, my ride's gonna be at 1/3. Okay, that's pretty interesting. I don't know if I want to be getting in a car with strangers at 2 a.m., but you know, I mean, that's kind of, you know, kind of the model. Is that going to be earth-shattering though? You got to say, if this really works, boy, this triples the company. I mean, we're talking massive stuff. That's why I can't see it with Walmart or most consumer goods. It's hard to see that kind of tripling. Now, if you do that, there's no way. So DCF does not work. So if you use DCF for these firms, it will always understate the value. Because the market's saying, hey, you know what? There's a small chance of this massive return. That's worth something. Just like an option. You have an option that has a 96% chance of expiring worthless. But boy, it's got a 4% chance of making you 80,000%. That has some value to you, right? How do you do that on DCF? The present value of that is probably 0 because it's probably not worth anything. 90% of the time, it's not worth something. How do you figure out the value of that? It's really tough. So you actually use option pricing theory value, which is pretty complex. If you look at everything you put into an option pricing model, you now got to do that with a company in that particular line of business. So I haven't looked actually at Damodaran's model to see how he actually sets that up. It seems pretty unwieldy to me to come up with these assumptions, but that's what you're trying to do. So it's good to think about that. Does your firm have that? Because what this can mean is you could actually put in your paper, while we did not do contingent claim model in this analysis, I think the reason my firm looks expensive is because they do have this opportunity that should be valued, but right now it's valued at 0, right? Because if they haven't done it yet, what is it in your cash flows? It's 0. So if it's 0 on your cash flow, but it could be massive, you're valuing something at 0 that the market could be valuing at 25, 30, 50 billion dollars. Okay. So it's good to know that it's there and to think through that concept. There's a good chance you'll never see it your whole career. I mean, very few people actually use this analysis with companies. Right, so there's the models we're going to use. So the question is going to be this growth rate, all right? So how are you going to come up with your growth rate? So we already know you're going to use dividends, or you're going to use free cash flow per share. You already got your discount rate. So really all we're missing here is the growth rate or growth rates. You might have multiple growth rates. So we got the terminal growth rate. That one is, I'm going to keep it pretty simple. It's what you used in paper 4 when you did the implied approach, is how fast you think the economy is going to grow. That doesn't mean your firm matches that, but it's going to be relative to that. So you might have a firm like a Walmart. You say, well, I think the economy is going to grow about 5%. But boy, I don't see Walmart growing even that. I see Walmart is slower than that, about 4%. Because, you know, we're talking consumer groups and goods and pretty basic. And so I'm going to come off of that by about 1% or something like that. But it's going to be close. You're not going to say the economy is going to grow 5% when my firm's terminal growth is 12%. You're not going to do that, right? You can't grow that much faster than the economy. So if you think the economy is going to grow 5%, your terminal growth is going to be, you know, probably 1% within that. Now, if you think your firm's going to go out of business, so that its terminal growth is negative 100%, then you know, why value the firm? So I don't know anyone that values a firm says, you know, I think 50 years from now they won't exist at all. I mean, I guess it's possible to kind of value what remaining life they have, but it would be unusual. Most of your firms are 100% of your firms, you're assuming they're going to be around as long as you can think, right? None of you have a firm that's going to shut down in 50 years. So you'll probably be pretty close to this range. You might be in the 3 to 7% range, but you'll be pretty close. But you say, well, what about Facebook? Well, eventually Facebook does everything they're doing, and it's all advertising. What's the max advertising revenue Facebook can have? Well, it's 100% of the advertising dollars in the United States, right? Our firms that are spending, you know, 20% of revenues on advertising gonna suddenly start spending 40% on advertising? No, so what is Facebook doing? They're stealing ad dollars from TV and newspapers. The most they can ever be is 100% of ad revenue, and that's assuming Google doesn't exist and nothing else exists. So there's a limit. Once they get there, they're gonna get there, and how much do you grow after that? You know, it's inflation, maybe it's population growth. There comes a point you've done everything you can do. You've run out of people. You run out of people with money, and once you've saturated, you have to stop. So every single firm, no matter what they're doing, Tesla, whoever it is, eventually they've done everything they can do, and they're just going to grow with the economy. All right, we already talked about that in paper 4, so we don't need to do that. So what about near-term growth? All right, so some of y'all seen this before. So go back to your paper 1, and my paper numbers changed, right? So get with the new program here. Clicked on it. Recognize it. So paper 1, you did your quarters, you had this final conclusion. Is your industry growing a lot faster than the economy or much more slowly than the economy? Remember, paper 1, I kept emphasizing that's your goal, that final conclusion. Is this an above average growth industry, or below average growth industry? All right, so that's going to feed in. If you're above average growth and you think the economy is going to grow at 6%, then you know you're above 6%. So below average growth, then you know you're below that. All right, so paper 1 sets that up. So you can't have finished paper 1 saying, wow, this industry has a lot of opportunities, looks really strong. And then you come to this paper and say, I think the growth is going to be 2%. It just doesn't make sense. You got to be consistent with those papers. Boy, I should have. I didn't think about this when I changed the paper numbers. So I read through all my notes, but boy, I'm reading fast. And I just didn't notice that. Paper 3. So the other thing is 2, 3, 4. What were you saying about your firm? And then you have paper 4, which is the kind of the gorilla on your back here is you have a forecast there. Right? So you've already said what you think about the growth rate. If you're using 7-8% earnings growth in paper 4, then don't come around with a 3% growth rate in paper 5. All right. So go back and look and see what your near-term growth rate. In fact, you could, if you wanted to, just pull your growth rate from that paper and make that your growth rate in this paper if you wanted to. All right. Remember, the ultimate is asset turnover times margin, which means this chart could be referred to again in this paper. You're saying, are they improving on that? Or are they getting worse on that? Or has it been pretty flat? If their asset turnover margin has been really flat for years, then why would you assume their growth is going to be higher going forward than it's been in the past, unless you're expecting some major thing going on? So this is what I love about Damodaran is all of your assumptions need to be internally consistent. You can't be all over the place. So think about what you've said before. And this crushes some students because they were writing paper 1 without thinking about paper 5, because it's almost impossible to think that far ahead. I'm not saying you're stuck with paper 1. So if you get to paper 5, you're like, okay, or 6, you're like, wow, I wish I hadn't said that in paper 1. Then that's fine. You know, you can go back and edit your paper 1 or but you know, think about what you've said before. But I do think the asset turnover times margin is pretty key. If your company is expecting growth much different than the industry, then you got to have some explanation for that. And that comes down to market share. If your firm's going to grow 12% in an industry that's growing 5%, from whom are they stealing their market share? And how many industries is there a big player that's stealing market share and the rest of the industries are like, well, that's fine with us. Go ahead and take our market share. Most companies are going to fight hard. Now you can say Netflix stole market share from Blockbuster. Does that mean Blockbuster just sat there and let them do it? You think Blockbuster was doing whatever they could to win that battle? Absolutely, but they lost. So I always thought that at USAA, our CEO was like, USAA, you're going to increase your market share every single year. I'm sitting there thinking, from whom? Where are we going to get this? Maybe Federal Credit, Wells Fargo. What are they going to think about it when we do that? But Part of it, he knew he could get away with it, partly because USA almost never advertised, and so y'all probably see USA everywhere now, right? And they used to not advertise at all. It's kind of amazing the places I see them advertise. Someone got an Amazon package at home, and she thought it was from USA because they had USA all over it. So Amazon, I didn't know Amazon was doing advertising on the deliveries, but yeah, it's like they're advertising everywhere. But eventually they do that and that stops. How else are you can market share? What else are you doing? Because if you're stealing people from Navy Federal Credit Union, you're going to do something to try to get those customers back. So think seriously again about that. How will the market react if you're growing faster than the market, and why are they losing market share? That gets back to that economic moat that you talked about in paper 2. If they have an economic moat so they can keep that going, then that's how you play it here. So really this paper for this class should be one paper you write all at once, but that would just be pretty crushing. You know, we do the entire class, you don't write any papers, and you write all 9 papers the last 2 weeks of class. That would be the way to do it. Boy, you would not sleep. It'd be like my job that I had for 7 years. All right. So there's a few things you can look at. Analyst forecast, I told you about that with Costco. I did my forecast for paper 4, and then I go look at and see what Bloomberg analysts are saying and see how consistent they are. You can certainly do that if you want to send input. You can look at analyst expectations in the PEG ratio. So what is the PEG ratio? It's PE ratio divided by expected growth. So there's a growth ratio forecast right there. So let's look at that. Look at it with Walmart. So you go to statistics. So here's the PEG ratio. How far of the growth rate do you get? Next 5 years. Now, how precise does that mean? That's the average growth rate over those 5 years? Is it the growth rate every single one of those 5 years? Where did they get this number from? So the footnote will probably say Reuters or something. Let's see, where's the footnote? There are no footnotes. I don't know how to get to the footnotes. How can you have footnotes and not have footnotes? Oh, here it is. Oh, my word. Refinitiv. Boy, that's the first time I've seen this. It's almost always Reuters. Who is Refinitiv? Huh. I've been missing out. This is part of the problem being retired. It's like, wait. Financial technology provides financial software and risk solutions. Boy. Did they put market cap over here? 18,000 employees.
Yeah.
2018, were they a spin out of Reuters or something? Subsidiary of the London Stock Exchange. Boy, I'm sorry. All right, I was expecting to see Reuters there or Thompson or something, but okay. So how good are their forecasts? Who knows? But let's use them. Right? That's a good approach. I don't know if they're any good, but I'm going to use their forecast because I don't know what else to do. All right, so you take their PE ratio and divide it by the expected growth, you get 3.38. Now, which PE ratio is this? It's the forward PE ratio, all right? Not the trailing, but the forward. So we've got a forward PE of 2237. And a PEG, whatever it was, that's a pretty high PEG for a Walmart, 338. All right, now if you go out and look up PEG ratios, there are groupies, there are some incredibly fervent groups of people who believe in the PEG ratio and nothing else. And they'll tell you, don't ever buy a stock with a PEG ratio over 1. I don't believe that whatsoever because that ignores what drives PE ratios. We'll talk about with paper 7. Obviously, PE ratios are high when interest rates are low and low when interest rates are high. So there's no reason why you should have a PEG ratio of 1 constantly. All right, so we got a PE of 22.47 and a PEG of 3.38. So what is the growth? and equal 22.47 divided by 3.38. Can someone do that for me, or let's see, 47. 6.65. Is that 665%? Or 6.65%? 6.65%. All right, so they convert it to an integer and then they divide it out. Boy, that sounds really high for a growth rate for Walmart, especially given what's just happened with COVID. So that seems a little unbelievable to me, but could they do that? What have they done historically? You can go back and look at that. That's a pretty heavy growth rate for them historically too. But that's what people think. It's a number. That's what college students do a lot is, I need a number, there's a number. I don't really care if it's any good or not, because I got to get a paper written. That's fine, but when you get in the interview, you better make it, you better sell it. Yeah, but I did a back analysis of integrating all these functions, and I came up with 6.6, whatever, make it sound good. There's a number from somebody, and a company I've never heard of before. So there's somebody's number. But it's a start. At least it's a number to compare to your number, if not anything else. And the other problem is it's 5 years. If you're doing a Alphabet or a NVIDIA, 5 years may not be long enough for your short-term growth. You may be going 10 or 15 or 20 years. So that's another challenge. Let's look at NVIDIA and just see. All right, let's see how good a forecast is for you. What is NVIDIA's PE to PEG ratio going to be? Any guesses? Over 10, below 10? Over 10? Over 20? So I like what Darren says, and I've actually done the math. You take the hyper growth firms, the Intels, Microsofts, and you look at their super growth period. Yeah, they're 10%, 15% growth rates, but hardly ever for more than 10 years. It turns pretty quick. 10 is a really high growth rate. But we'll see. We'll see what the market says. Oh, NVDA, excuse me. All right. 48. It's more than 10. So what is that, about 15, 14?
Yeah,
14%. So that's a pretty high growth rate for the next 5 years. Could they do that? So, I mean, the other thing you do, and I'll probably show you this next class, but I love to put these forecast growth rates against historical growth rates, just to kind of see if it makes reasonable sense.
I wanted to, I this with you for a while. You specifically use your version of the data just because and how it would be 98% down, especially for more because new companies some changes. So I believe that going forward, especially with that companies that you can't really use historical growth rates as much because we don't know how much technology.
Right.
Currently, IoT is in every cars, station points, everything, and B is that it has so much potential within the market. So yes, it's an extremely high growth percentage.
Well, for 3 or 4 years, it's not that bad. If someone had this for like 15, 20 years, there's just no firm I can find historically that could just sustain that for that long because it's just so massive. Well, it could be NVIDIA takes over the world, or it could be some new firm comes in and completely puts them out of business too, which is what I'm hoping happens. I love companies going under because a better one comes along. So that is a number you can use, but it's your numbers, whatever you think about the company. And this is really forecasting the future is really tough to do. So well, let's look at a boring company then. And I can never remember Kellogg's K. How can I not special K? There it is. 15 over 2. That's a pretty high growth rate. You know, 5 point something percent for Kellogg's. That sounds pretty high. And they did pretty well. I was reading an article that Americans don't like to cook, and restaurants are closed, so they start eating cereal. I love cereal. I could live entirely off of cereal. Campbell Soup, another firm that probably benefited, not quite a high growth rate. That one's what, about 3%? That seems about right to me for Campbell Soup. But it's somebody's forecast. Gives you something to compare to. Well, what Darren says, and I'm going to say the same thing, when you get to the H model, it's not so much the growth rate as it is the H. So what he says, and I agree with it, he says, you think this firm's going to grow really fast for 15 years? Cut that in half. You cut it in half again for the H, but cut in half. Do you think it's 15 years? Use 7.5. Because firms can almost never deliver that kind of hyper growth as long as you think. And so that's his argument. I think just me looking at the data, I have to show you that spreadsheet one of these times.
Well, just to get the number, it's over 3 divided by the ratio, right?
Or PE divided by PEG ratio, and then essentially you have to divide by 100 to get it into percent.
So that is over 50%.
For which firm? Yeah, Netflix is a kind of a strange one.
That's why I want to make sure you know the right.
Yeah, that's yeah, that's well, even with Harvey's comment, that's a pretty ridiculous number. Yeah. And I don't, I have never been a believer in that. I'm a believer in Netflix's management. I think they do a great job. I love what they did. They essentially cannibalized themselves and said, you know what, we're going to destroy this business because this other business is more important. And we haven't gotten our full margin out of this business. It doesn't matter. We're moving to online streaming. Forget about, I love it. That's great management. But their model is customer times the monthly fee. And they're spending billions of dollars to try to get more customers to come on. What I don't like about it, y'all can maybe explain this to me. What I don't understand, if they have more people streaming on their service, there's no more revenue. This isn't where you're paying for use, right? So if I go watch 10 movies a month instead of 3, the movie theater loves it. If I watch 10 movies on Netflix instead of 3, what does Netflix get out of it? Maybe I get more customers and I encourage them to come on, but it's a monthly fee. So they got somewhat of a fixed bucket and they do all this extra production. They get more people watching, but they get more customers. At what point do they just can't get more customers because everybody that's going to sign up has signed up? Yeah, increasing their prices. So that's the thing, get us hooked and then they can increase it. But they make it so easy to cancel. So why do we talk about switching costs? What is Netflix's switching cost? Practically nothing. It's really easy. I look at YouTube, I see a movie I really like, and they're going to charge me $1.20. And okay, I'll pay $1.20 to watch that movie. At least they made $1.20. With Netflix, I'm like, well, I want to get hooked on this new program. Yeah, okay, I will, but I'm going to do 1 month of membership and I was doing that for a while, going between Hulu and Netflix, and I just turn one off. Hey, they got Seinfeld now. I'm over here. So I don't know. I can't go out into my mind. Netflix is a great company. It's going to make a lot of money. I can't get in my mind that super growth because they're having to spend so many billions of dollars to get there. That just seems tough to me.
Other streaming platforms like HBO and Hulu, they have the advertisements.
Right.
Whereas
Yeah, Hulu seems to be the one that people are dishing on the most, but they are keeping that advertising piece. I may be misunderstanding Google, but the YouTube, what is their monthly membership?
pay like $10.
Yeah, it seemed awfully expensive.
But it only works for music. Like everything else has ads. The music videos. And
I thought they had a video service where you could exit the ads. I have to look that up. I saw it once and it just seemed incredibly expensive.
Well, it used to be called YouTube Red, now it's called YouTube Premium, and it takes away all the ads on like any YouTube content. And then you get.
I mean, they irritate me because they're putting their ads on my UTSA videos, and It's like, and I don't think I can monetize that because I don't think UTSA would appreciate it. So I don't know. I'm not a believer in Netflix. I'm a believer in the business. I'm not a believer in the stock price. The same thing with Tesla. I think when you value Tesla over every car in the world, they're trading more expensive than other car companies versus the number of cars they're actually selling. You know, Tesla's being priced to take over the entire world. Can they do that? They could, but there's also a pretty good chance another company is going to come along, and especially from China, and do it just as well. And you know, so I don't get convinced with extreme. What I like is the company has that optionality, and they're not trading so quite that rich. But all right, so there's one forecast. And you can certainly look at the history and look at your forecast. I mean, Harvey is right. Those could be really different, but if they are really different, you need to explain why, what you're thinking, right? So if the company's been averaging growth 5%, and now you're going to kick them into an 8 or 9% growth, why? What are they going to do differently? So they're going to do something that's, and remember, it comes down to asset turnover and margin. What are they going to do different? Either kick up their revenues or reduce their expenses, get more efficiency. You have the sustainable growth formula, which is normalized. I added a word here, normalized ROE times retention. You could certainly use that formula. You do need to normalize it because ROEs jump around. How do you normalize it? You could just take the median of the last few years. You know, if you're doing Carnival Cruise Line or Delta Airlines, you know, last year just messes them completely up. You just can't do that. And some of these firms, like a Walmart, boy, their numbers are, you know, Netflix, its return on equity, 39%. What's their retention though? The retention is probably zero, right? I don't think they're paying dividends. So the retention is 100%. So there's your growth rate right there, 39%. Yeah, that's a pretty hefty growth rate. But even Walmart, return on equity, 12%. And what's their retention? You may know what the retention is? 39%. So what is 12? 39. Oh, exactly. That's pretty reasonable. The last time I looked at Walmart, their ROE was much higher. Did I do waste management again? Nope, I got Walmart. So their ROE has actually come down quite a bit since the last time I saw it. So that actually is a fairly reasonable number. So that's one. That's the theoretical one. The problem with this approach is it assumes static asset turnover, static margins. If you're seeing changes on that, you have to make those adjustments. So there is no source for future growth. It's your assumption. There's no place to go look for future growth. I gave you a future growth here, which is entirely reliant on past. I gave you a future growth here, which is entirely reliant on somebody else's forecast and only goes out 5 years. So there is no place to go, but you do have your forecast in paper 4. Always remember economic moats. So don't forget that. Remember the other term for economic moats? Or sustainable I always get those competitive advantage. Do they have a sustainable competitive advantage? And what will stop that advantage? Is it a patent running off? Is it, you know, some new technology that's going to come along? What is it? I haven't quite figured out this new Uber thing with Hertz, with Tesla, yeah, and Hertz. And I don't know why it's with Hertz and not with Tesla. You know, it just seems really strange to me. Yeah, you mentioned, yeah, how do you get the math to work on this? I'm not real sure what all that means. Oh, that's not how you spell competitive, is it? What is that word? Is that a word? Bill Gates seemed to like it, but so you always get back to that. If you're going to have really high growth, where is it? Why is it so? In NVIDIA, it probably has some knowledge, some expertise they have that no one else can replicate, and they can keep that, but they can't keep that forever. But what is it that they have that gives them that type of advantage? All right. Well, we're at a point where I don't want to start something new.
would we start H next?
Yeah, I don't want to talk about H right now. I want to get into that. It's down here in the notes and I want to get into it a little bit. All right, so for this paper, the main things you're going to need are the dividend or the free cash flow, short-term growth, long-term growth, and H. Maybe the earnings per share and inflation. So maybe 7 numbers. There aren't really that many numbers that you need. Let me show you the proprietary model just real quick. So you can kind of see if that's something you might want to use. I've had a lot of trouble remembering where I put stuff in. Is it in there? Ah, there it is. Okay, I'll put it on the class models and templates, which makes some sense. So you start with earnings per share. So it looks, almost a little bit like capitalized earnings. And then you ask, how many years, this is not the H, it's the actual number of years. How many years will it take for them to go from really, really high growth down to terminal growth? I put their terminal growth at 6%. Their starting growth at 25%. Here's their discount rate, 9.6%. And then I said, when they get to this terminal growth, 6%, they will start paying a dividend of 40% of earnings because that's a fairly typical dividend of a stable firm. And so what I do here is here's the earnings per share growing, but not growing at 25%, but growing at 25, 24, 23, 22, all the way down. And I got an if function in there and I just ask, once I hit that year and I hit that 6%, so it says do it over 20 years. And then once you hit that, go to 6% and then you're 6% forever. And what do you notice when we hit 6%? We got a dividend. And then we start doing the present value of the dividend. And so how much is it worth, the stock? $15.40. I think I'm off about $400 there. Oh, about $2,000 there, $1,500. Now we're Google. Yeah, these stocks. I can't remember when I updated this. So $15.40. Now the earnings is probably higher too, but I don't think that's going to save me on this one. The earnings per share. Oh wow, that might help me. 103.80. This must be from several years ago. All right, that helps. So now they're expensive. And so this one says, oh, I didn't mean 25%. I meant 20. I meant 24. I meant 23%. That's what a lot of students do. It's like I is a typo. I meant to do something else. And why do you think it's 23%? That's what the market is. If you do that, you have no value to your boss, because your boss can look this number up. I think Google's worth $29.16.98. That's just my estimate. Why? Because I think markets are really efficient, and I really don't want to do that number. All right. So this model can work, but you got 3 betas, so you put your 3 betas in there. You have to write the numbers down. Whatever it is. So you put your, I should have done it here, right? You put your betas in there, you recalculate, you put your growth assumptions in there, you recalculate. So you can still get your 3 scenarios doing this, but it's going to take you step by step. You are welcome to use this model if you like. You notice, Henry, in this model, you don't need dividends. All you need is earnings. So it works pretty well. It's a lot better than that capitalized earnings model, especially for a Google, because you can put hyper growth into it and get a much better answer. All right. All right, let's stop there because I do want to talk about the H, but I don't want to talk about that tonight.